I'll just hit right into you there, Mark. Okay?
Sure.
All right. And away we go. Welcome. You're listening to The Best of Investing on Talk 910, the show where we present valuable information, very valuable information.
Absolutely.
Especially today. Audience, make sure that you stay tuned for the entire show. We're going to be talking about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown. I'm proud to have as my co-host Mark Hahn of Pacific Private Money, California's fastest growing private mortgage investment firm, and Rob Spinoza of RPM Mortgage. Our phone number is 888-912-1190. Write that number down. You're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. The vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. And the vacations are free. Their only request, a $75 cleaning fee to cover housekeeping expenses. Such a deal. And by the way, you don't have to attend any timeshare presentation or anything.
Oh, darn.
Oh, that's what you want to do. Okay. All right.
No timeshares.
No timeshare presentation. Okay. Their website is lighthouse4fun.com. You can reach them at 916-777-5511. Call them up, find out what they're all about. Today's trivia theme is cereals you hardly see anymore.
Wow.
I think you asked me for that.
Oh, maybe I did.
Someone did. Okay. Cereals.
I'm all about the American diet.
No,
I had
actually,
cereal for breakfast this morning, in fact.
yeah. Well, a lot of people don't know you're the runner, aren't you?
I've been called worse.
Okay, and this segment of The Best of Investing is brought to you by crystalbull.com. Now remember that's not crystalball.com, it's Crystal Bull, as in bull market. And if you ever wondered why the stock market has big up or down days when new economic data are released, check them out, actually, crystalbull.com. They show relationships graphically. By the way, our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. And we're also on television, Comcast Channel 26 and AT&T Channel 99 at Saturdays at noon and Sundays at 6 p.m. Now, Mark, we're going to get right into it. You've got some very interesting articles.
Well, I came across this. I was doing some, real estate research that I do every week for the show, and I thought this just jumped out at me, and I thought this was really interesting. So, according to a recent poll, 57% of Americans still think the economy is in recession.
Hmm.
Isn't that
Okay.
something? This is ABC News Wall Street Journal, so it's not just some
Right.
internet poll.
Right.
And they're saying that, so even though the economy technically emerged from recession 2009, 5 years ago, that 57%, most Americans still think the economy is in recession. And
You know what? I believe that, though, because there's still, it's like the rich get richer, the poor get
Yeah,
poor.
yeah.
On the lower end, I think there's still a lot of people who are still struggling.
Well, I think it's more of an indication of not so much, is the economy technically in recession as it might be, is the economy doing good? Is it doing well?
Right. Is it serving the most the way they need to be served, I guess, is what you're trying to say with that.
Well, and so let's talk about it. I mean, you've heard the complaints about, the 1% are the ones that have gotten all of the new income. You got all those wealthy tech multi-billionaires that have sprouted up thanks to the tech bubble surge. And then you've got, wage earners who aren't in a position to increase, their wages. And really that's really what the gist of this article is about. It reflects the failure of most Americans, I think, to feel like they've recovered at all, and the ability to participate in any kind of recovery.
Well, I think too that one of the things that happens when you're talking 2009. I mean, we've got that 5 years ago, 5 years in the rearview mirror now, and what tends to happen too is that people's expectations of what a good economy is begin to change. So, to get back to El Arian's comment, the new normal. What is the new normal? And whereas people may have known before, let's say you've got 10 friends and 2 of them are unemployed, that was shocking back then. Now that's becoming more normal to see that, and then you go about your daily life and you don't think, or you do think that we're still in a recession based on that kind of readjustment of expectation. It's interesting.
Well, and let's just take the real estate industry. I mean, I'm interviewing right now for for a processor to assist our existing processor, and there's no shortage of applicants because what's happening in conventional loan origination right now. I mean
How about that one?
how about that? Our 22,000 mortgage jobs axed in the fourth quarter. Oh my gosh!
Yeah,
You know,
yeah.
So most people in real estate loan origination know and realize that we went through a 10 or 15 year period where rates continued to get lower
Right.
and lower and lower, and with every new low there was a new wave of refinancing. Well, most everyone in the industry today believes that we're done with, there will be no further refinance waves in the years in the coming years.
No, I totally agree with you. I see that happening within our industry. I do residential mortgages, so that's all we do.
Yeah.
But one of the things that has been big news in the last couple of weeks has been that Wells Fargo started it, Carrington Mortgage is following suit, and that is that in order to gain additional market share and replenish volume that has just simply evaporated, they're lowering FICO score requirements. So you have
the antennas just went up. Are we going to have another wave of these?
When I
Well, no, because see, the difference is it's one thing to loan to lower FICO scores. It's yet another thing to lie about income.
I agree.
So the bubble wasn't so much about people or banks making loans to people with bad credit. It was they were lending to people based on income that was not accurate and
Right.
not true and completely misrepresented, either by the borrower or the broker itself. The broker said, well, I'll just put down here that you make $150,000 a month and we'll get you approved.
Right.
I wonder though how accurate though the FICO scores really need to be in order to make a decent loan.
Well,
You know what I mean?
I've always, I agree with you, Edward. I've always said that when I look at a borrower profile, if you take a borrower that, let's say he's got a 640 FICO score, but he's got $500,000 worth of liquid assets available.
My question is, why does he have that FICO score?
Well, he could have been
Yeah.
involved in a medical collapse, something,
or divorce. A lot of times,
a divorce, any of those life events. But if you, what lending has become in a lot of ways, it's become this straight line. If you have a less than 640, you are not an eligible borrower. And I think that detracts from what really should be happening, where an underwriter looks at a profile and says, I think Mr. sub 640 with 500K in liquid assets is a stronger risk profile than the person who is right at the edge on their debt to income, has no money saved, but has an 850.
Okay, here's the other question though: and I don't think anybody really knows the answers. How do they actually get that FICO score? Isn't that kind of a proprietary type of
It
number?
is.
And it gets adjusted, by this, that, and the other thing.
It is, but I mean, everybody's playing in the same game, so there's a consistency amongst it.
And Robert, you hit something right on the nail. It's funny because as a private money lender, what we see at Pacific Private Money is applications all the time from people with scarred credit.
Right.
Because if they had presumably the idea is, well, if you had great credit, you'd go to a bank. Which again, we could as listeners know, that's not always the reason why people go to private money lenders or hard money lenders.
Right.
It's not necessarily because they can't get it from a bank. It might be speed. It might be other reasons. But I have applicants sometimes come to me and well, I'm going to put this property in my son's or daughter's name because they've got a really good FICO score. Well, they've got almost no trade history.
Right.
And yeah, they've got a 700 plus FICO. It's like I tell them, no, that's not of interest to me. I want you to be the borrower. You are the person. Don't prop up this, your son or your daughter and say, well, I'm going to put them on the loan because they got good credit. That's not going to make me want to loan you money anymore, because that's not how we feel. At least in private, that's not how we determine whether I want to make you a loan.
Well, it's funny. I remember when I still sell disability insurance and life insurance, and like for disability insurance, it's amazing how people would say, well, I don't need this policy. I make I have a lot of money in the bank, a lot of interest income, and that sort of thing.
Right.
They're trying to puff themselves up, right? So you're thinking like the bank. Okay, if I don't need it, they'll give it to me.
Right.
With disability insurance, it's the
opposite.
Yeah, because they say, well, if you don't need it, then you stub your toe and you go, whoop, that's it. I'm disabled.
Right, exactly.
Okay, we're going to cut to our first commercial break here. This is good, very good stuff, guys, and I know we have a lot more interesting articles for people. Again, the theme, here's our trivia theme: cereals you hardly see anymore. Of course, I hardly see them. So here's the first one. this serial's character was usually seen with Frankenberry, and usually he would talk like this. Which serial was this? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190. You may have to ask your kids to help you on these questions. To answer this question, this serial's character was usually seen with Frankenberry, and he would talk like this. Which serial was this? Don't touch that dial. The Best of Investing will be right back. Make sure to include your name and your email address. Again, 888-912-1190. Don't touch that dial. We'll be right back. So, I'm not sure why.
Yeah, something happened. Was it okay on the?
On here it's fine. His started,
This
and
mic
that's
was
why.
weird,
Yeah,
and
that's
that
why
one.
I did. So the thing is, it's funny. If we can keep our
keep
your hands to yourself. Keep your hands off the table.
Hands folded on
and
your
make sure
lap.
that nothing is,
I
is
do
getting
that.
the,
I
is
do
getting
that,
the wires sometimes.
Okay.
Yeah, I had to get burned that towel because when we talk about sports, he goes bam, bam. I give him a towel to everything.
You were going in a direction before where I was going to talk about how people are being how the home stats, the sales stats are changing because people are being their income and wages is not keeping up. They're being pushed out affordability wise as the prices go up. That was kind of it didn't segue in, but we've got it there.
Well, and I've got California February home sales stats.
I have that too. Okay.
Without being, boring about this percentage, that percentage. I just
How do I look?
unit sales are down 10%
Look
year
good.
over year.
Every morning I
And
get
yet,
up. I go,
They're nowhere
hold on, I gotta do
near
my hair.
where they were,
done.
in 2004 when it was.
And my wife says, how do you get dressed so
40,000.
fast? I go,
I mean,
because
we went from
there,
28 last year to 25.
We're
So we're
good,
down
aren't we?
10%.
We are.
But
thing is,
normal is
I get my
almost
gray hair though
50,000
starts to
units
show.
a month. I mean, we're
Well,
just nowhere
I have
near
some
that.
shoe
We are
polish.
not in a healthy,
Yeah.
Bring it next
vibrant
Yeah,
real
but it
estate
gets
market.
but suddenly it's like my receding
That's a
hairline
bright
is.
spot
Oh my
against the
gosh.
I
backdrop
polish
of the
that
rest
too,
of
buddy.
What's that?
We'll polish.
Polish that
But
too. Yeah, give me
anecdotally-
some polish. Put it in.
Right.
I checked the MLS 2 weeks ago, or last week rather, in Nevada. So we're in March now, which are not affecting these stats. There were like 30 or 40 new listings. I mean, I couldn't believe it. It just like was
What
night
price
and day.
range? Well, Nevada is pretty.
Nevada, it was.
Yeah.
I'm looking at stuff from like 600
Yeah, I was gonna say
to
6 and up.
$1 million
Right.
ish, but I didn't chop it.
No, right.
I
but
just
that's
actually
where
said-
I would expect.
I was just shocked. I put up my days on market,
Mhm.
and I was shocked at how many new listings there were. Just so, and again, I go regularly on, and there'll be a new listing here, a new listing there, but there were
Yeah.
like 20 new listings within so anecdotally, at least for Nevada, I gotta believe that's gotta be the same elsewhere as that listings are up.
That's right.
Hopefully, yeah.
Okay, good. Away we go. Well, welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money and Rob Spinoza of RPM Mortgage. When we got to the first commercial break, we asked this trivia question about cereals. This serial's character was usually seen with Frankenberry and would usually talk like this. Which cereal was this?
Mark's been chomping at the bowl.
That would be Count Chocula.
Count Chocula, that is correct. All right.
Even I didn't like that cereal, and I love those sugary cereals.
Oh, I know.
Something about Count Chocula.
Yeah, that one didn't do it for me. I was a Cocoa Krispies fan myself, which is not one of the trivia
Oh,
questions.
okay.
That's why I can mention it. Okay, where are we going with the show now, guys?
Well, we were talking about in the last segment. We started out by talking about how 57% of Americans still think we're in recession, and one of the reasons that is that for most people who are wage earners, hourly or salary, none of us have really been seeing the kind of annual increases. We're not in an economy, generally speaking, where we can command annual
Right.
increases.
What's the unemployment rate right now?
Wasn't it under like mid sixes?
Oh, got that good?
Yeah, I think it's in the mid sixes.
Yeah, that's because
6.7 rings a bell.
half the population stopped looking for a
Well,
job.
Well, that's
yeah,
why. That's
yeah.
what they're saying that unemployment's slack. So it's just it's not that it's bad on paper, but it's that there's underemployment, which is a number not represented, meaning people
I
who
think
are
that's a
earning
big component.
considerably less than they
Right.
may have earned at the height of their career. or they just stop looking.
I wonder how many people scaled back their standard of living and basically said, you know what, I don't have to work now. I don't need 3 Mercedes. I'll just kind of cut back.
Yeah, I think there's a component of that. I also think that what you have, one of the other things that I've noticed is, and last year was a big help in this regard, not having employment and then also having your home declining in value makes a person sort of more present in feeling the pain when their value starts going up in their house and in their stock portfolio. It takes the edge off of that. That's what I've seen amongst people as well. So I think that there's,
Well, so we're 5 years into an economic recovery, and there's a number of really interesting statistics that you can find as you're looking at some of what's happening out there, and it's really unusual, and we're in a very atypical recovery. And so here's one stat I thought was interesting, and that is that first-time home buyers have been missing from the housing recovery. And so the statistic is that on average, 40% of homes sold were starter sales to first-time home buyers. Well, that number is now it's down below 30%.
I was going to say in the 20s.
So it's in the high 20s, mid to high 20s. So we've got real estate prices going up. We've got unit sales though going down. The number of unit sales on a monthly basis are just a fraction of what they are considered to be in a healthy market. We've got first-time home buyers that are missing, and you know that there are a lot of millennials chomping at the bit to move out of mom and dad's home.
Right.
That's because we know that percentage is high. I mean, we talked about that. I forget that it was like 30% of people between a certain age and their 20s are still living at home. So there's a lot of pent-up demand for housing, but you've got lack of inventory, you've got affordability issues.
And you have a highly competitive market in a lot of areas. We're in the Bay Area, so we tend to, impose our experiences on the rest of the country, which may not be true. The rest of the country right now, you hear a lot of talk about the harsh winter and how that's affecting stats.
What harsh winter?
Right, for us, we've had this glorious
news.
So we have
Sunny out.
we have to hope that there's a lot of truth to that, because otherwise they're going to come off of that winter and their stats aren't going to be so impressive, and then they're going to have other issues to deal with.
I wonder how many of those people are going to move out to California because of this last winter.
Well, what I was going to piggyback on what Mark was saying.
Good luck finding housing.
Yeah, right. One of every
rental or purchase.
Yeah, right. That's true too. Because
the rental market's super tight right now.
I'm going in the rental. I was just going to read. One of every 8 American households rents a single-family home. One of every 6 occupied single-family homes is occupied by a renter. 1 of 6.
Yeah, that's huge.
So that's kind of an interesting stat. And there are more households living in single-family rental units than there are rental units in properties with 10 or more units.
See, that reflects the trend that a vast majority, I don't know what the percentage is, I apologize, of homes that were foreclosed upon starting in 2007 through, say, 2012, the majority of those were purchased by companies who just were able to amass cash when most of us didn't have cash at that point, and just bought up thousands and thousands and thousands of units of real estate.
That's what Warren Buffett wanted to do. I don't think he did, because he said he couldn't figure out a way to manage it all.
Well, and I want to come full circle.
So there was a huge conversion, in other words, from home ownership to rental. The same housing stock, but instead of now being owner occupied, a hedge fund now owns it, and you're renting.
And that I want to come full circle on that, because we started talking about first-time buyers here, and when I get an application for a first-time buyer, I know what they're in for right now in the current market. You like you said, they're facing affordability issues. You've got very high competition for desirable properties. Anything that's desirable in a price range that a first-time buyer could access, chances are there's going to be a lot of competition and bidding for that, which may force them out of the game, because they may not have the cash position to deal with the overbidding and or the appraisal not coming in at value. Or not at value, but appraisal not supporting the purchase price,
Right.
So first-time buyers have their challenges. They should continue to try, obviously, but going in that direction. I think one of the things that highlights is and there's a balancing act here. But back in 2004 and 2005, when we were talking about the higher housing stats, maybe some of those buyers got in because they were using products that were riskier, that allowed them to finance a greater percentage of the purchase price, and that allowed for a more competitive, or I'm sorry, a less competitive environment in the purchase transaction itself. So there's always a balance to be struck, and I think we are still on one side of the pendulum. I mean, we have really, credit is still restricted. First-time buyers are bearing the brunt of that. There's not a lot of new housing stock, as you pointed out, so it presents its own challenges to the first-time buyer.
Well, we're not adding a lot of housing stock in California right now. That's clear. And the number of unit sales. So February's unit sales that just came out a couple of weeks ago was 25,000 units sold in California in the month of February 2014.
Okay.
What does that mean? Well, that's down 10% from a year earlier when it was
That's
28,000
Yeah, that is
units.
interesting.
But what is that? Again, what is 25,000 units sold in California versus 28,000 units sold in California? What does that mean? Well, a healthy February on average is over 40,000
Yeah.
units. The high was 2004 when 48,000 units sold in the month of February. And we had an article here in a show we did a couple months back, and a healthy, vibrant California housing economy is considered to be, on average, 60,000 unit sales per month annually.
Oh, wow.
And we are nowhere near that. And
Well, a lot of hungry real estate agents.
there's not, and I don't know when we're going to be near that, because we've got this quandary, this catch-22 of we still have too many houses with no equity or not enough equity to sell. We don't have a lot of new housing being built because obviously the builders don't think it's profitable enough yet. That housing prices haven't rebounded enough to make it profitable. So that's kind of a head scratcher. And so you got people who, and even people who want to sell and can sell, who have the equity.
Where do they go?
Where are they going to move?
Yeah, exactly.
So it's like, well, we got to buy a house first. We got to get the contract first before we put our house on the market.
Right.
So in fact, we're doing a lot of transactions for people at Pacific Private Money where we're giving them a private money loan to buy a target property before they put their house on the market, and they go private money because the bank's not going to make them a loan for a second home. They don't qualify for two bank loans. So it's a really interesting phenomenon we're in right now.
Okay, we're going to go to our second commercial break. When we come back, we've got some interesting emails, and audience, you're not going to believe the reason that Mark was able to get a deal, why the bank had said no to this one borrower. Even I couldn't believe this story. Okay, here's our second commercial break, and again, the theme is cereals that you hardly find anymore. Which cereal typically had an athlete featured on its cover? I haven't seen that one for a while. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website, no, that's not it. There's no accent on this one. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Which cereal typically had an athlete featured on its cover? Don't touch that dial. The Best of Investing will be right back. The next question's hard.
Oh, okay.
Because it was a cereal I didn't even like.
Oh.
Pickle flavored cereal.
Pickles! Pickles and ice cream cereal. That's for the pregnant.
Bacon. That would be
Bacon, yeah.
Bacon cereal.
Bacon, anything is good.
There's a section of Powell's that just has bacon, like bacon honey, bacon chocolate, bacon.
Works for me. Okay, we'll get into the email time. I'll get you to explain that really interesting story. I always like to tease the audience. Keep them connected, right? You ready?
Yep.
We're just motoring through. Are you ready, Mr. Kramer?
Mr. Kramer's ready.
There we go. Well, welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with Mark Hunt of Pacific Private Money, California's fastest growing private lender, and Rob Spinoza of RPM Mortgage. When we get to the second commercial break, Great. We asked this question, trivia question about cereals you hardly see anymore. Which cereal typically had an athlete featured on its cover? Wheaties, yeah.
Get your Wheaties.
Does Wheaties, does it still exist?
Well, I think so. I just don't see it anymore. Maybe that was a trick question. Maybe a lot of people go, oh, I see it all the time.
I still eat them.
Okay. Okay.
So why aren't you playing in the NBA?
Yeah. Answer is that one, Mark. Okay. So, Mark, we have an email that leads right into what we told the audience we would get into right at the commercial break. Okay. So here's a question. It says, I've heard you on the radio that you can fund a loan in 5 days. How can that be?
So the question has to do with, it's about the loans that at Pacific Private Money that we fund on a regular basis. We're a private money lender, also known as a hard money lender. We're based in the Bay Area, and our primary borrower clients are people who are buying, fixing, and flipping real estate. And because of the market that we've been in the last several years, it's been pretty competitive among real estate investors looking for opportunities to buy, fix, and flip property. And so fast closes is not uncommon. Now, the question was, I've heard you say you can close in 5 days or less. Well, we don't like to close in 5 days or less, but we can close. In fact, prior to the story I'm about to tell you, our fastest close was we got a call on a Tuesday morning.
Funded on Friday.
And we funded and recorded on Friday.
Wow.
I thought that was, now that
great.
would require me to find an outside investor, one of our private clients.
I thought you were
fund
going to say a
that loan.
5-hour energy
Right.
drink.
Yeah. Well, now we have a fund which does give us flexibility if we happen to have the capital in the fund at the time to fund even faster. Well, here's the new record from this past week. I get a call on Wednesday night saying, and it's from a good friend of mine, mortgage loan originator, well known in the Bay Area, and he says, I can't believe my client just fell out today.
Ugh.
We have to close on Friday. Can you draw docs tomorrow and possibly fund Friday morning for a recording on Friday? And I said, well, I think so. We'll give it a try. As it turns out, we were
What's
able
the
to do
deal?
it. Now here's the deal. You just love. So the guy's buying property in the house was in Petaluma, a newer home. He's buying it for $725,000. He needs a $500,000 bank loan. He has $225,000 in cash. Now, maybe you'll understand this, Rob, because I don't quite get it, but he believed that he was approved for the financing until the bank investigated the source of the funds.
Okay.
And even though he believed he had gotten a green light, I guess, previously, because why would it have gone all the way to like day 27 on a 30-day close? But it comes to find out, the bank said, well, the account that you're bringing in the rest of the money from is a business account,
Right.
and that doesn't meet with our guidelines, and therefore we can't fund
could
that.
be.
And is he a Schedule C?
I don't know.
Well, typically they would. Well, let's not get into. I want to hear the rest of your story, but underwriting guidelines would often state that on a business, if the CPA could state that the removal of the assets from the business would not cause it harm, then they could get it to go. But yeah,
But he controlled the company.
right. So I don't know.
Right, so it was his company, it was his DBA. I don't believe it was incorporated, so I think it probably was a
Right.
Schedule C. So,
Yeah.
so as he was doing
Weird.
business as he's a contractor, and the money was coming from one of his bank accounts, but it wasn't in his personal name. The bank decided that it didn't meet with whatever their cash seasoning guidelines.
I was going to say,
Could be anything.
and if he said, okay, hold on, I'm going to put it from the left pocket to the right pocket,
That's
and
true,
then write a
too.
check to myself,
That's
put it
true.
in my personal account, they'd say, well, it's not seasoned anymore.
Right.
So the moral of the story, I guess, is just if you've heard that it's harder to get bank financing today. Well, there's an example of a guy that is putting down 30% in
Right.
cash on an acquisition, which for a bank loan is actually pretty large down
Yeah,
payment.
that's a safe loan to make.
And the bank said no, and he's about to. He'll be out of contract after Friday, or would have been out of contract after Friday. So anyway, we were able to do that loan. We did a very, very fast loan, 9.9%. It turns out that I actually ended up knowing the guy, and I may have charged a slightly larger fee just for the incredibly quick time frame in which we had to literally drop everything and put that loan in the front of the queue. But we
Not
charged.
easy.
I actually started to charge 3 points, and we ended up going down to 2 points. So $500,000 at 9.9%, 2 points. He's going to pay it back probably within, or I should say, he'll get a bank refinance within 30 to 60 days. So it's really a bridge loan, meaning it's a very, very short-term, super short-term loan, which in my fund is no problem at all for us to do. So anyway, moral. Happy ending for everybody.
Yeah,
he
very
did not
good.
lose his deposit. He's married with kids. This was their dream
Didn't lose his
home.
wife.
Yeah, right, exactly.
Yeah.
So again, very, very fast close.
That's great,
Can
Mark.
only be done in the private money realm. So, if you think you know what a hard money loan is, you've heard about it. It's those guys that lenders of last resort to, charge an arm and then a leg. That really is, that kind of lending model doesn't exist anymore. Those guys largely went out of business with a lot of the banks that went out of business in 2008. The new hard money is called private money for the most part, private money loans, and it really exists to fill that gap that is really not being serviced by the banks. That includes investor financing and any type of financing that requires lightning speed to close.
Well, what's really surprising on that one is it seems like he was assuming that the bank had already known that it was coming from his
I'm
business
sure he
account.
was. Yeah, I'm sure he thought that at that stage of the game that his
Otherwise,
assets had
if
been
he would
verified.
have known that, he would have put it into his personal account 3 months or 2 months ago.
Right. Well, I mean,
And a Schedule C, it's not like he's getting taxed anymore.
right. I mean, what we have to assume here too is that even if this weren't the case, giving the loan officer the benefit of the doubt, there are scenarios where that happens all the time. I'll give you an example on an FHA loan. Cash is anathema. I mean, you put cash in an account that can't be sourced, and it can wipe out that whole account. So if a lender really wants to play hardball, and you go and you deposit $250 worth of, well, it probably has to be more than that. But if they noticed it and it was a cash deposit, now all of a sudden they say, we don't know what it is. We're nullifying that account. If that's the account they've got their down payment funds in, you could be right back in that position.
It almost seems like they were looking for a reason not to.
Yeah,
pay
I
the
mean,
loan.
but it's not that they're looking, and this is the thing that I wish everyone could understand, because it makes the bank look like the bad guy. The bank is not trying to deny your loan. Yeah, I'm seeing some faces here.
Yeah.
The bank's not the bad guy, but what the bank is also answering to a higher power, and that is the eventual investor in that loan. So if the bank takes and packages a loan and a deposit is not sourced, and the investor comes back to them 6 months down the road and says, hey, we think this account is got fraudulent activity in it, and you didn't document it properly. Here, take that $500,000 loan back, and it's on your shelf for good.
You know what? That'll happen anyway. I don't care what they do. They'll figure out. It's like
Exactly.
any legal document.
Sure,
Any
you can punch a hole in
attorney
it.
can punch a hole in it. Exactly.
But the fact of the matter is that the industry is hamstrung by that notion that the investor can come back and force them to buy the loan back, and it ain't going to happen on their watch. So that if they're looking at that statement and they think something's up, sorry, Charlie, go
Boy,
find a loan.
that's really got to put them get him kind of skittish. It's almost like an little old lady goes to a stock brokerage firm and says, you know what, I'm going to go for the gusto. Put me in the riskiest stuff possible.
Right.
Because
Right.
if they do and she makes millions of dollars, great. If she doesn't, she can just kind of go, real sulky. Oh,
Right.
It was unsuitable for me. You shouldn't have done
And
that.
they should have
I'm
known
a little
that. That's right.
lady."
That's
It's
right.
It's a no-lose situation.
Well, and it's funny because that talking about banks being maybe afraid of their own shadow. I also found a stat of the week. This is not a large number, 6%, but it's just interesting. 6% of small banks no longer offering residential mortgages thanks to the high costs associated with the Dodd-Frank
Well, that's a good
reforms
point.
put into place.
You got to be compliant on every level. We have at RPM, we have a compliance officer. We have all sorts of compliance checks throughout the system. We have a GFE desk that prepares our good faith
No,
estimates.
not a GFE.
Yeah, because
I have one of those in my plugs in the house, a GFE.
the good faith estimate.
Oh,
is
good faith estimate, I'm
It's a
sorry.
binding document, and so if you have 400 loan officers all creating their binding documents on behalf of the bank, you run a lot of risks. So our CEO said it's not going to happen to us. We're going to create a desk that's all they do, but they are bearing that cost.
Yeah.
It's,
Well, I can imagine, the bank looks at it and they look at the profit margin.
Yeah.
And they say, we're not making that much money on these residential loans.
Yeah.
As compared to
With all the
Mark's
risk
company
involved,
makes
yeah.
a lot of money on the residential.
Well, it's just interesting that you've got now, there are actually community banks out there that would decide no longer to make home loans because it's not profitable. That just seems like, talk about turning the whole banking business model on its head.
We talked a lot about this in 2013 as the Dodd-Frank stuff was coming down the pike and how it would reduce consumer choice, and you were absolutely right.
Okay, before we go to the commercial break, did you tell people how to get a hold of you?
I did not.
Did
So
not.
again, if you are a person who has need for fast financing, or you're a real estate investor and you're looking for an alternative source for capital, give us a call at Pacific Private Money. We're located in the Bay Area. Our phone number is 415-883-2150. That number again, 415-883-2150. Or go check out our website, which is pacificprivatemoney.com.
And if I remember correctly, your fund is still paying over 8%.
It is, absolutely. Well, maybe we'll talk about that one next week on the next show.
Okay. And when we come back, we got an interesting article for Rob here. We're going to cut to our third and final commercial break. Again, the theme is cereals you hardly see anymore. This one I haven't seen in probably 30 years.
Uh-oh.
Okay,
I might
this
get it.
cereal was introduced in 1965. Tasted similar to Captain Crunch. It was not Captain Crunch, but it tasted similar. Shaped like saucers, and its character was an alien with a propeller on its head. Okay, which cereal was this? And I hated this cereal. That's why I probably don't see it too much anymore. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. In fact, I don't even know if you could Google this one. Call 888-912-1190. That's 888-912-1190 to answer this question. This cereal was introduced in 1965, tasted similar to Captain Crunch, shaped like saucers, and its character was an alien with a propeller on his head. Don't touch that dial. The best of investing will be right back.
Stump the host.
I don't know the answer to that one. Yeah, I thought I would get all those 1970s ones because that's when I watched the most TV.
You would have seen this in 1970.
Yeah, I know, and I can't think of it.
Saucers.
Mr. Kramer, you're too quiet. Why are you so quiet?
I'm still thinking about Wheaties, Breakfast of Champions.
Yeah, that's right. And I think Bruce Jenner still looks the same as he did when he was on the box.
Yeah.
Oh, he looks scarier though.
No,
Yeah.
man, that's crazy.
He does not look well.
And he was the man back then, 1976.
I remember the first time he kind of just fell off the radar entirely, and then
After he divorced his first wife, who was gorgeous. But go ahead.
and then I see a picture of the guy like I don't know 5 years ago, and I'm like, who the hell is that?
I did recognize him. Yes. All right, let's see what we got here. We have 9 minutes left.
Talk about cereal for 4 of that.
Sorry, that was funny. Okay. And away we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff and Rob Spinoza. When we cut to the third and final commercial break, we asked this trivia question about cereals you hardly see anymore. This cereal was introduced in 1965, tasted similar to Captain Crunch, shaped like saucers, and had its character, and its character was an alien with a propeller on its head. Which cereal was this?
What, Sugar Pops?
No,
I don't know.
Quisp.
Oh, yeah, Quisp.
Hated that.
Wow.
It was almost as bad as Kix.
Yeah, I thought that was going to be one of our trivia questions, but
There was a joke about that where these trolls are looking for. Why is it going crazy? The trolls.
see, you start screwing with kicks.
Yeah, that's right. These guys go to the rabbi. The rabbi, hey, he kicks us all the time. And then they go, the rabbi comes, and the troll doesn't kick him, and he goes, why? And he goes, silly rabbi, kicks are for treats. Okay, I'm sorry, that was a bad one. Okay, email that
I know where
received
you're
for
going.
Rob.
That's funny.
Okay, I have, here's the email we received for you, Rob. It says, I have an FHA loan now.
Okay.
Is it a good idea to refinance to get rid of the mortgage insurance?
Good question.
Yeah.
Okay, so a little bit of backdrop on FHA. FHA is a loan that it's basically, for most people, a 30-year fixed loan, but it's insured by the Federal Housing Administration. So the key drawback to FHA is that when you take an FHA loan, the vast majority of them have an upfront mortgage insurance premium, UFMIP, and then they have a monthly mortgage insurance premium, MIP. So the MIP is similar to PMI on a conventional loan. And it's an insurance premium you're paying to Federal Housing Administration, HUD, to insure the additional risk in the loan. Now, why this is all important is because when subprime went away and when a lot of the creative financing that was in existence 04, 05, 06 leading up to the crash, when all that stuff went away, it left a tremendous void, and that void was filled by FHA, because FHA would allow a borrower to finance up to 96.5% of the purchase price, so a 3.5% down payment. FHA at the time here in the Bay Area had a maximum loan limit of $729,750. So you could finance basically an $800,000 house with 3.5% down, and you just couldn't do that anywhere else. There were no jumbo programs; most of them were gone. So between the years of probably 07 and 2010, a lot of people got FHA loans that previously would not have, because FHA, there used to be a joke. It stands for 500's all right, which meant that you get an FHA loan with a 500 FICO score. You couldn't do that any longer, but you still had way more lenient FICO restrictions than conventional. Your debt-to-income ratio could be substantially higher than a conventional loan. A lot of people end up in FHA loans, so now they're thinking, well, the value has come up on my house. Can I get out of it and get rid of that mortgage insurance? The answer to the question, the short answer is you've got to do a careful analysis, because there can be drawbacks to getting rid of the mortgage insurance premium, and there can also be some scenarios where you absolutely should do it. If you took a loan, an FHA loan in 2013, for example, very likely that your mortgage insurance will be in place for the life of the loan. So it doesn't matter what the house is eventually worth, it's not going to drop off. So a conversation with your loan officer has to be, when will I lose my mortgage insurance? When will it drop off automatically? Because FHA will go based off of the original price, and you have to be at 78% of that before, and 5 years for most loans before it comes off. So the answer is, you want to talk with a loan professional about it. You want to do all the analysis and then go from there. And if it's worth doing, then get into something better.
Well, and now we're in a rising interest rate market, so although we're still seeing some fluctuations where it's dipping back into the fours, lower fours, but still, it's a little bit of math analysis.
Yes, it's a little bit of math, and I've actually seen some scenarios where the rate on an FHA loan could be in the low 3s and it could go into the low 4s, and the deal is still better to go with the higher rate. So you've got to look at it very carefully, because if you're not going to lose that mortgage insurance in a reasonable period of time here, or if you're not going to lose it at all, or if your tax bracket is such that your benefit is better at the higher interest rate, you got to look at it carefully. It's not a simple equation, and involve a professional and get the answers you need.
Do not try this at home.
Do not try it at home. It's a little bit more complicated, and when we look at these, we go back to the origination of the loan. We figure out what the rates of mortgage insurance are and all those factors, and base our analysis from there. So that's what I would recommend.
Very good information. How do people get a hold of you?
They can go on to the Best of Investing website. There's my bio there and my contact information. And I'm at 415-367-5959. I work for RPM Mortgage out of the Mill Valley office, but I can originate loans throughout the state of California. And I'm always happy to hear from someone from the radio show. Yeah.
Absolutely.
Let's see, we have just a couple of minutes left before we get into our thoughts for today.
Sure. So I was just telling Rob off the air that even though the stats for it's the end of March, stats for February came out that says housing unit sales are down year over year, and they're way down from a healthy real estate market. But anecdotally, I was on the MLS in the city where I live, which is Novato, recently, just looking to see take a look at the housing stock. And I sorted by new listings.
Okay.
And usually there's 3 or 4 or 5 new listings coming on. There were like over 20
That's good to hear.
new listings in the month of March in Novato.
Good
And
to hear.
so
Is that just because of the spring?
We hope.
Well, we hope. I mean, clearly it's it's the old refrain is that it's after the Super Bowl that people get serious about putting their housing back on the market again. So, but anyway, I thought that was fabulous. I was thrilled to see that.
Yeah.
I don't know how that's if that's being replicated throughout the Bay Area.
Interesting, yeah.
But certainly, in Nevada, which is a very popular bedroom community for people who commute to the city, that was something that I was very, very pleased to see that the housing stock increased substantially.
I'm very encouraged as well by our capacity to lend, and I'm seeing, and we've talked a lot on the show about restrictions and how difficult things can be, but still, the amount of programs we have, the not creativity, I think that has a bad connotation, but the ability for us to make common sense loans has increased since 2012 and 2013. So I'm very heartened by seeing that, and I'm hoping it forms a great confluence with with additional housing stocks that people can actually buy.
Yeah, so I think the moral of it is you're reading these articles, which is based on information that's 30, 60, 90 days old. If you're eager to get back in the housing market, call your realtor, because maybe this week the news is brighter than 6-8 weeks ago, and certainly it appears to be heading in that direction.
All right, guys, thanks for joining us again today. Just want to make a little friendly announcement here to our friends at OARS, O-A-R-S, picked by National Geographic as the best river and sea outfitter on Earth. They offer more than 75 professionally guided raft and sea kayaking tours. Check them out at oars.com. That's OARS.com. Great, guiding life's greatest adventure since 1969. Here's our thoughts for the day. You know that phrase, cat's got your tongue? Question, what were you doing with the cat? And I saw a sign on one of those power drinks that said, finish your energy drink. There are sleepy kids in India. Now that's super compassionate, don't you think? All right. Tune in next week to the Best of Investing. We're going to have more interesting stories, I know for sure. I know Mark's got a lot of good loans to talk about. We'll also be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Good. I think part of it was this mic.